As we've seen in the past few years, investing in crypto can be an absolute goldmine, but if you're not careful, it can cost you big in taxes. In today's video, we'll look at the 5 most common mistakes Australian crypto investors are making in 2025. And at the end, I'll show you one hack that solves all of these with the click of a button. Number 1, failing to report crypto gains and losses to the ATO. Now, this thinking has been going on since the beginning of crypto, where a lot of people assume the ATO has no visibility into what you're doing in the crypto world. The bad news for you, if that is you, is the ATO has complete visibility into the crypto world. And in fact, crypto is often more transparent than the traditional fiat system. For example, once someone knows your wallet address, anyone can go on the blockchain, look it up, and see every single transaction you've ever made. The ATO have a lot of sophisticated technologies now that can do this exact thing. And when you register for an exchange account in Australia, you have to go through a KYC or a Know Your Customer process, where the exchange has to see your ID and identify who you are. They then pass this information on to the ATO along with the wallet address. So as soon as you make your first trade, every transfer from there is tracked across the various blockchains. Now sure, you might be able to come out of the woodwork and say this particular obscure coin isn't tracked by the ATO, and I don't know, but the ones that most people are tracking, like Bitcoin, Ethereum, Solana, these kind of more common coins, absolutely the ATO is tracking it. And in recent times, the ATO has actually been sending out letters to crypto investors saying, we know you've been trading crypto and we know you haven't reported it, so please report those gains or losses.
I will look for you, I will find you, and I will kill you.
So the big mistake there is the ATO treats crypto a lot like property, in that the various events that you do during your crypto transactions are capital gains tax events. So every time you sell a crypto for a fiat currency, that is a capital gains tax or CGT event. Even when you swap one coin for another, so if you trade some Bitcoin for Ethereum, that is a capital gains tax event. Even the fee on some wallet transfers is treated as a capital gains tax event. So to handle all this, you need to keep very detailed records of every single transaction along with the gas fees or the network fees that happen, because these are critical for reporting to the ATO. Mistake number 2 is misunderstanding how crypto staking rewards are treated when it comes to tax here in Australia. A lot of investors mistakenly think that when you receive a crypto staking reward, it just adds to your coin balance and there's no tax event. Unfortunately, that is completely wrong. So how the ATO treats it is when you receive a staking reward, they treat it as if you received actual fiat cash into your bank account. So to calculate tax on that, you need to figure out what the spot price is at the time you received that staking reward, and that's how much cash you report to the ATO as income you received. There's a big trap here in that you might receive a staking reward now when the price is, say, $1,000. Then in 6 months' time, the price of that coin might have rapidly dropped or rapidly increased, which results in a big capital gain or loss that you then have to pay back on this crypto staking reward. So it can be quite volatile to do crypto staking when it comes to tax. The way around this is you need to meticulously track every crypto staking reward transaction so that you can then calculate what the spot price was on the day you received it, which tells you what the AUD value of that crypto staking reward is. And all of those need to be summed up and given to the ATO at the time of your tax return. Now, if you've staked a coin before, you know they often pay out a staking reward every single day. So that's 365 transactions you need to keep detailed records of for the entire year. Now, if you've been staking a coin for 2 years, 3 years, 5 years, that is a lot of transactions. We're talking into the thousands of staking rewards. And remember, for each one of those, you need to be calculating the AUD value at the time you received it so that you can report it for tax. So make sure you're keeping very good records of all your staking rewards. The third mistake is not accounting for crypto airdrops correctly. Now, similar to staking, crypto airdrops have both an income tax component and a potential capital gains tax component further down the line. So when you receive an airdrop, you need to calculate what the AUD value is of that airdrop on the time you received it, and that is the amount you're reporting to the ATO as income. But an airdrop can also open a whole new position in a coin you've never owned because it is airdropping you a quantity of that coin. So you need to keep track of the spot price for not only the income tax component, but also for the cost-based component of that new position. Because if we go to sell that particular coin in, say, 6 months, a year's time, you need to be able to calculate the capital gain based on the fiat price that it was worth at the time you received it. So again, you'll notice a common theme here. Meticulous record keeping is absolutely essential for crypto. Mistake number 4 is failing to account for crypto losses. So if you're new to investment tax, you can actually offset a capital gain with a capital loss. So that it means if we had a big winner that we sold and made $5,000 capital gain, but then over here we sold one of our losers and made a $3,000 capital loss, that $3,000 will offset from that $5,000 and leave us with only $2,000 left that we need to pay tax on. Now this is a really important thing because this gets into the realm of tax loss harvesting. So if you know before the end of financial year that you've made a bunch of sells on some winners and you're sitting on a big capital gain, you can actually look through your portfolio of crypto and find the ones that aren't performing well or that you no longer believe in or that you don't think are going to go anywhere, and you can actually sell those off to realize the loss and then use that loss to offset the capital gain. Now the really cool thing is if you're into stocks and crypto, you can actually use losses from crypto to offset your gains from stocks, or the other way around. You can use losses from stocks to offset your gains from crypto. Because they're all investments, if you have them all in the one portfolio, you can now use the gains and losses to offset each other, despite one being crypto and one being stocks. Now this is a really common area that investors across crypto and stocks overlook, and that is using those losses rather than just sitting on them. Now, mistake number 5 is when people are confusing their personal crypto transactions with their business crypto transactions. Now, this relates if you're doing some trading in your personal name and some trading in a business name. You cannot get these mixed up because they are completely different entities. If you buy some Bitcoin in your personal name and then you transfer it to your business name and then you do some sells there, that's not all part of the one entity. So you have to account for the different capital gains tax events when you transfer the coins from one entity to another, and it can get really messy really quickly. So it's really important that you keep meticulous records for your personal crypto transactions and for your business crypto transactions, because messing it up can get you in a lot of trouble with the ATO, particularly if you think the capital gain was for one entity when it was actually for the other. This leads into an interesting issue with wallet transfers as well. So a wallet transfer can, from one entity to a different entity, trigger a capital gains tax event. And this is where people get caught out with the personal and business transactions, because they're treating both wallets as the same thing. They're both my wallet, right? According to the ATO, no. One is your company's wallet, one is your personal wallet. So make sure you don't get that confused and messed up, or you can end up with an audit on both entities and maybe end up with a fine for both entities as well. So to recap the 5 mistakes, there is one theme that goes through all 5 of them, and that is meticulous record keeping. It's the records that are going to save your ass at the end of the day when the ATO wants to audit you or give you a big fine. You need to be able to prove exactly how you calculated those capital gains or exactly how you came up with that income figure, so that when they come asking, you can present the records. Now, I'm the founder of Novexa, which is Australia's highest rated portfolio tracking and tax reporting platform, and we cover crypto tax extensively as well as tax on stocks. So like I mentioned earlier, you can have a blended portfolio of both stocks and crypto and sort your tax in just a couple of clicks with Novexa. If you're interested in that, check out the link in the description.